Hey traders, Raghee here. Welcome to our pre-market show. All right, should be good to go. Happy Wednesday. So how's everyone doing? Hope everyone's doing well. Got a lot I want to cover with you all today. Got a lot in the notebook. Good morning. Good morning. Hey there, Matt. Hey there, Em. All right, looks like we still have some folks coming in. Okay, very cool. Very cool. Okay, gang, so let's get to it. What we're going to do is we're going to kick off the morning with a look at the economic calendar, and then we'll move on from there. And let's see here. Let's jump on over to Forex Factory. Now, yesterday, if you caught our episode yesterday on Tuesday, the 10th, we did a deep dive into tradingeconomics.com, into forexfactory.com, and Estimize. Got a lot of questions about the way that I look at Estimize and my earnings approach. And everything about the earnings approach begins with the calendar. And so one of the things that I mentioned is while we do as day traders and as trend traders, end of day, daily time frames, and even short term, we need to be aware of the potential volatility events of earnings. But when I'm planning for runs into earnings, I'm actually looking at those as being events that I prepare for about 6 weeks ahead of the event. And that's where I got into this data right there, the estimize.com free website. One of the other questions that I had, it was a volatility question. And that has to do with this site right here and some of the tools that I use. Now, when I talk about using volatility, I'm rarely actually looking at implied volatility or even IV percentile. I want to be aware of what that is, and I want to be aware of IV crush in front of major events. But what I do want to be aware of more regularly is the typical price movement range of any stock that I'm looking at. Now, a few of the stocks that I've got in mind in terms of a watch list for this week, and ETFs, by the way, I'm looking at TLT, TSM, FedEx, Nike, and XLE. So I have quite a few of these that I'm going to be updating for our folks who just took the ETF Masterclass, as well as our Sector Secrets Mastery. And I'll be talking about these as well on Friday in the options room for those of you that join me there. But just to give you guys a heads up, I'm looking at some potential exhaustion in the bond market. That's something that's definitely on my radar. So what you're looking at here, this chart right there, let me zoom in so you can see this. So what we're talking about here is typical price movement range on the ZB bond futures. And what we're looking also to do is take advantage of some exhaustion. And the question is exhaustion into what? Exhaustion into where? So let's take a look at the daily time frame and start with the ZB. So as I take a look at this particular contract, what you'll notice is that, let's zoom in a little bit more, or I should say zoom out a little bit more. We are sitting at what's known as the value area low for the current year. That's the 2020 value area low. It's also a double bottom, but this is where we've been really cautious. We've been talking about this in the videos nightly, which is was dangerously close into turning into a double red downtrend. And sure enough, today we have it. So I would highly recommend only going with the TLT bonds, because this is a very fresh reorganization of a downtrend. And I typically don't look for oversold buys in downtrends, but rather overbought shorts or rips that I can sell into, bounces that we can sell into. So this is something I've been waiting for a while. I was really expecting this to go double red, but hoping it wouldn't, so we can still justify a buy. But I think there's a few things we can still validate as support, and therefore we'll go in with options. And again, I'm going to use the TLT. Go out to January on these, gang. I'm eyeballing the 155 calls in TLT for January. And what I like about this is the value area low, the fact that we still have the mean on the V-score holding as support. So I've got this volume weighted average price standard deviation that's reverted to the mean. That's support. I've got the value area low, volume derived support level. And I've got a price based, we can argue, a double bottom or at least a retest of this previous low that we saw right in here. That's one of the things on my radar for today. One of the things we have seen is that the bond yields have continued to rise. If we're going to see a bounce, I'm not talking about a prolonged move to the upside, gang. This is a trade. If we're going to bounce, let it be to perhaps the value area high of this month, which would be around 174. Let it be to the point of control for the year. But I'm not looking for a prolonged move to the upside. This is a short-term bounce setup, which is not that unlike what we were looking at in gold. I'm looking for this zone to potentially hold and set up a long position. We're going to have another arguably better opportunity to pick up some oversold long positions in gold in this area between 1875 and 1850. So today we're seeing a little bit more weakness. Do I still like the long gold position? I do. And again, this would be for a bounce. Now this would be, and this is not the first time that we've taken this. In fact, the most recent time was just right in here. And I'm just looking to basically run that playbook all over again, basically in here. That's all I'm really looking to do. It's just running that same exact playbook again in pretty much identical zone. So gold and bonds are sitting at oversold levels. The question that I then get is, well, Rog, would you short gold or would you short bonds? From the current levels, no. Remember, if you're looking at any kind of setup, you've got to think about a trigger. So I may want to buy, let's take a look at the IYT. Let's jump over to the IYT. I may want to buy names within an ETF. I may want to buy a particular stock, but it may not be in the zone that I would buy it from. Same thing, I may want to short a particular name, but it's got to be in the zone that I would short it from. So one of the things that we've been looking at is FedEx within the IYT. I'm going to keep recommending that if you are playing futures to the long side, focus on the Dow. If you're looking for ETFs and stocks, again, with a path of least resistance to the long side, look at the DIA, XLU, IYT, and XLI. Do what you can for now, for the most part, to avoid the volatility of the, let me zoom in here to the NQ. Do what you can to avoid the volatility of tech for now. It will bounce. I feel good about tech at some point bouncing, but be careful because, again, the work from home narrative and the tech unwind that comes from the vaccine optimism is going to hit the NASDAQ the most. It's going to hit the S&P the second most, and it's going to hit the Dow in the least impactful way, because the Dow, the tech weighting that the Dow has is more of an XLK conversation, which is to say it's really an Apple and Microsoft exposure. All right. CRM's in there as well, of course. All right, so let's take a few questions here. And good morning, good morning. Great to see everybody. Fantastic. All right, do I think the stimulus narrative pushes the bond market higher? I would presume, Samuk, that dollar would go lower. I'm short dollars, and that bonds would go, bond yields would go lower, and that, which is higher movement on the ZB contract or higher movement on TLT. And I would then assume that that would send gold back up. That's a lot of assumptions, but that's what I am anticipating. Now, the narrative is not the setup. The macro is not the setup. Those expectations are not the setup. I'm still looking for levels from which a gold buy, a bond buy, and a dollar short makes sense. So I can have a narrative, to your point. It's very important, I think, that all trades have a story behind them. I think the trade story makes a lot of sense. And I think ultimately a trade or even investment is a story, a narrative that you can back up with price. And I think that second part is really important, because otherwise you've just got a story, which is, I think, what the flaw is in most macro analysis, which is it is a narrative that is rooted in numbers. But until those numbers, until that narrative is factored into price of stocks and commodities and treasuries, et cetera, it is just a narrative that perhaps no one's paying attention to. So I have to acknowledge that I might have a narrative that nobody's paying attention to. And if that's the case, price is what lets me know. Volume is what lets me know. Even volatility lets me know that finally it's being paid attention to. So great question. So gold's down 22, which is about half of its daily price movement range. It's on a significant move. Really, it's a lot of movement probably for this time of day. But in terms of the overall scope of what gold is capable of doing, it's not a lot. It's about half. So let me show you what I mean by that, by saying that at this point in the morning, it's a little unusual that gold has moved this much, but for the entire session, not so much. So take a look here. Our most volatile hours for gold, by the way, are between 7 and 10 a.m. So where we're moving right now in terms of time is, it makes sense from a volatility standpoint. This is gold, by the way. This is really important and interesting data, gang. And the folks who can harness this data and understand this data, you have an edge on the rest of the market. It's really that simple. You've got an accuracy that is a historically validated amount of volatility that has a very high probability of giving you not directional clarity, but volatility clarity. So I know that between 7 and about 10 a.m., almost 11, that I'm going to see, really 8 to 11, that I'm going to see some of the most volatility in gold. And you can see that in play really right now, right? However, let's take a look at one other chart. What is the gold typical volatility? Now notice Wednesday actually happens to be one of the most volatile days for gold historically, not specifically because of today's action. When you go back 6 months, this is actually a really volatile day, which if we print 41, 42 points, I will be 0% surprised. So we're in the most volatile window intraday, and this is the most volatile day of the week historically for gold. So keep that in mind. What this is going to allow you to do, and this is really important, gang. What this kind of data is going to allow you to do is put a measuring stick against the stock or the ETF or the commodity. And what happens is a lot of traders don't have this kind of measuring stick. They don't have the ability to, they're looking at maybe an average true range, which is fine, but it's a very shallow look back. I would not consider average true range historical look back. I would consider price movement range, PMR, and average true range, ATR, to be cousins, right? They're very, very similar in what they measure, but how they measure it is extremely different. And I think the historical look back on a PMR, price movement range, for the hourly and for the daily is just a completely different set of data points that I rely on in a different way than average true range. So really interesting stuff in terms of what you can take out of that information. All right, so let's jump on back on over to NQ, ES, and YM and take a little bit of a day trader's tack at this, which is we want to continue to be optimistic on all things Dow, transports, utilities, industrials. I know that utilities aren't specifically a piece of the Dow, but it's much more a Dow conversation than it is an S&P or a NASDAQ conversation. The other thing to remember is that your Dow is going to be a beneficiary of a narrative that preceded the election. It was really one of the only narratives in the equity markets that I felt would succeed either way, and that's infrastructure. I think there are some other narratives, and we've talked about these, so please stick with them. My watch list is not a twitchy watch list, right? I really don't want to encourage twitchy behavior. What's twitchy behavior? Over trading, market orders, frequent frequent round trips, which is really over trading, a very large watch list, trading without triggers. When you don't have, yeah, I'm a diver. I'm actually a dive master, and that was what I was doing even while I was trading back in college. And we us divers have a saying. It's plan your dive, dive your plan. And you plan your dive because if you're taking multiple dives on a particular day, you've got to be aware of your exposure to depth and how long you could stay at depth and the amount of time that you need in between dives. And I think those things are very applicable to trading. So you can't overdive. You'll get yourself sick, and you can't overtrade. You will get yourself sick. So I think twitchy behavior is what we want to avoid. So when I say that we want to have very stable, reliable watch lists, it's to say that we want to review them daily if necessary, but they really should not change day to day. And we'll have a more in-depth conversation about watch lists in an upcoming show. All right, so next up is, do I have recommendations as to where we could turn to better understand correlations? AJ, I'm not a big fan of correlations. I'm a big fan of causation. I think Nassim Taleb had a great quote around the 2008 financial turmoil. And I don't know if that was just popularized at that point, but that's when I was exposed to it back in '08. And that is that correlation is akin to charlatanism. And it's true. Things can correlate that have no causation. If you can find correlation that's rooted in causation, that one thing is affecting the other, then you've got something real. If not, things can just coincidentally be moving, and there might be a lot of middlemen in that relationship. For example, I don't think gold and the markets are really highly correlated, but the markets are correlated somewhat to bond yields, and bond yields correlate to gold. You've got bonds as the middleman sort of in that correlation. But the causation for gold is real yields, the causation for movement in gold. So there are very few high correlations in the market. The highest and the most steady is the correlation between the euro and the US dollar. That's your highest for sure. Let me show you here. It's an inverse or negative correlation. So be really careful on correlations. AJ, terrific question. It's something that I've studied a long time. I mean, VIX has a correlation inversely to the equity markets. Yen typically has an inverse relationship or negative correlation to the equity markets. Comdols, like the Australian dollar, typically have a positive or sympathetic correlation to the equity markets, but nothing is always, nothing is 100%, except for the relationship between the euro and the US dollar, which is almost tick for tick, a negative or an inverse correlation. All right. But, you can look at these tendencies, but don't hang your hat on them. They're far from being setups. But one thing that they do actually offer you is when the market is well structured. Let me show you here. I'm going to head on over to a site called, in light of this question, a site called FinViz. So I can take a look at the one-day relative performance of currencies. This is the current relative performance. What are currencies saying right now? Well, dollar is strong intraday. New Zealand dollar is strong, but it's been the strongest currency. We've had a long position in New Zealand dollar, so I'm certainly happy to see that. Just bear with me here one moment. There we go. And yen is right there in the middle. That's not really a great correlation. What I want to see is strong Aussie, weak yen for correlation, confirmation of equity strength. So this would be a mixed bag in terms of what it's saying about the prospect of a stronger equities market today. And remember, currencies are the largest market in the world. Is TLT a short? No, it's a buy, Esteban. I'm looking for long calls in TLT. All right, let's see. What other questions do we have here? A lot. And by the way, just to kind of put a bow on the correlation conversation, it's observation, gang. It's observation. Again, those are some of the places you can look, mostly where you want to narrow down your market barometer for these types of correlations, causations, VIX, yen, bonds, Australian dollar. I think those are some big ones to focus on. After that, really what you want to do is you can't say that those four markets are going to indicate what the markets at large are going to do. As I mentioned earlier today, we have relative outperformance in certain parts of the market. So you're better off not looking for correlation, gang. You're better off taking, say, the S&P, cracking it open and saying the sectors and the stocks that are heavily weighted within the S&P, could be the SPY, could be the S&P futures. What are they doing today? If I'm looking for relative outperformance, the NASDAQ, I really don't care what the VIX is saying, right? Because I know that the Dow is outperforming the NASDAQ right now. However, I do care what XLC is saying. This is largely Facebook and Google. I do care what XLK is saying. This is largely Apple and Microsoft. And this kind of sector-specific trading is what I like to do when it comes to the way that I build my watch list and the way that I play my stock and ETF options. And that's something that we're doing in the Sector Secrets Mastery. You can check that out over at simplertrading.com. So part of it is this conversation that we're having here today. And this is a correlation conversation. And I think it's a much more practical correlation conversation, which is, why is the S&P strong or weak sector at a sector and stock level? Why is the Dow strong or weak? Again, at a sector and stock level. Why is the NASDAQ? And then you're going to find out why certain days the NASDAQ could be a laggard and the Dow could be an outperformer, or vice versa. So that's the kind of causation you really want to focus in on. All right. So I am out of time, just like that. Boy, that 20 minutes flies by. So thank you as always for joining me for our morning show. I will go check out any of the questions that y'all have for me. And is there a list of the different sector ETFs? Project New Sense. Yes, check out sectorspdr.com. Sectorspdr.com. That's a great place to look at the list of the different sectors that are popularly traded and the stocks that are trading within them. That website, spend 30 minutes there. It's a fantastic resource for understanding relative performance at the stock level, at the sector level. There's a little bit of an earnings calendar there. Fantastic free site. I'm a big fan. I'm a big fan of that. Stockboy says, I'm having a hard time learning technical analysis. It's a process, Stockboy. I'm 32 years in and I'm learning new things all the time. I'm doing something right now where I'm blending candle patterns together to see. I mean, it's always going to be, there's always going to be something we're learning, but I hear you and I can sympathize. I've been there, but it's also kind of exciting, right? Everything's new. So if you're frustrated right now, be happy about that, because you're firing and wiring all sorts of new synapses. You're all sorts of new ideas. And I think that frustration is actually, interestingly, a good sign that you're in that process of learning and you're training your eyes to see the things that you're reading in the book. And it does take a little bit of time. What you can do as far as advice goes, sure, automate. You'll notice that even in our time here together, I rarely draw on my charts. I'm not looking to do manual analysis. I try to automate everything from particular candle patterns I look for to market trend analysis to, in this case, this tool down in here, gang, that's a relative performance tool. So I try to automate as much as I can. So A, it forces me to have a process that B, I then program in, or a programmer programs in for me into an indicator. And then all I've got to do is read the tea leaves, as they say. So I think one of the best ways to shorten the learning curve, at least that's what I try to do for my traders and students, is automate. Automate the decisions. Automate the things that I used to do manually. Automate. Okay? All right. So that's what I would focus on. And look, I'll tell you this too. Books never taught me what I know in the markets. They gave me ideas to look for, but you're going to be your best teacher, 1000%, right? Not me. I might be able to point you in the right direction, but the tough work comes with your training your eyes to see what I'm explaining, or to see what I'm trading, or to see what or any other teacher or mentor or trader is pointing out. And that's the tough part, that firing and wiring and training your eyes. So for sure, thank you for the question. All right, so let me get going. Is there an HPMR indicator for TradeStation? James, there is one in the works. Me and Mr. David Starr are working on one for TradeStation. It's going to do some things that I wanted to see happen in the tool, which is custom lookbacks and things of that nature. But this is in beta. So yeah, if you want to take a look here, this is in beta, and I'm very excited about probably early next year, Q1. This should be ready for showtime. All right. Okay, gang, I ran over a little bit, but I'm going to head on over to the rooms. Wherever you're heading next, simpler options, simpler futures, wherever it is, or just your trading desk. Thank you as always for spending time with me here in the morning. I'll see you tomorrow, 9 a.m. Bring your questions and or leave your questions here in the comments, whether that be YouTube or whether that be Facebook. I will go back and check them. All right, gang. Thanks for the time. I'll talk with you soon.